Last month, we witnessed the biggest collapse in gold prices for almost 40 years. The price of the precious metal plunged by around $300 an ounce in the space of a few days. And the great decade-long bull run for gold was at an end, the experts cry. Now, gold is a peculiar kind of a market. It's driven partly by demand for jewellery and industrial uses, but also because of its special status as a store of wealth. Now, central banks have huge impact on gold markets. For a start, many central banks hold big stores of gold bullion, and one reason for the dramatic price plunge was a decision by Cyprus to sell some gold stocks to help pay for its bailout program. Investors, though, have always considered gold a safe haven, particularly during times of high inflation or the threat of inflation, and that's where central bank policies come into play. One reason gold has been on such a run for the past decade is that loose monetary policy, or low interest rates if you like, has had investors worried about a breakout in global inflation. The ultra-loose monetary policies that followed the financial crisis had many convinced that we would eventually see hyperinflation. And so gold continued to climb right through the worst of the crisis, stopping just short of $2,000 an ounce in 2011. But it hasn't happened. Inflation has been contained and global economic growth is still weak. So last month's decision by the Bank of Japan to throw caution to the wind and embark on a huge money printing spree of unimaginable proportions, rather than fuel the inflation fears, it put a stop to them altogether. Because by depressing the yen, Japan essentially will strengthen the US dollar, or at least put a floor under it. So that will help to limit American inflation. For gold investors, it was the last straw. And so, as happens during market crashes, everyone decided to bail out at once. The diehards aren't quite so sure. They reckon the super loose monetary policies of the world's biggest economies will return to haunt us down the track. So they're hanging on to their gold. As examples go, last month's gold crash demonstrates just how central bank behaviour can affect markets and your investments.